Hi, this is Pat with Energy Solution Partners, sharing with you our energy market view on Monday, November 25th. A reminder, there is a risk of loss when trading commodity futures and options. I want to start by sharing with you the Heating Oil Commitment of Traders report as reported by the Commodity Futures and Trading Commission. This group that we're looking at is the Managed Money Group, which is also known as the speculators. And you can see, for whatever reason, this group has really abandoned the heating oil market over the last several months. It peaked out back in August-September timeframe with a net position 40,000 contracts long in the heating oil market, but since that time they've continued to sell that long position off and have actually worked into a net short position in the early November timeframe. For whatever reason, like I mentioned, that they really not participated in this heating oil market. But what this is telling me, there's just a lot of money that's sitting on the sidelines waiting to come in. I'm not sure what the catalyst will be to bring that money into the market here, but they can move the market quickly. This report is issued every Friday through the Tuesday of the previous week, and I would guess with the big market moves that we've seen in the last few days, we will see that they have brought some money to work in this market when we see this report come out next Friday. I want to focus now on the market structure and look at some of the fundamentals, which have really been a bullish story here for the last several months. But looking at this forward curve on the ultra-low sulfur diesel, this is really a bullish market structure when you see the backwardation in this market, where we're higher in the front months, but then we continue to slope backwards as we look into the outer months. But what this is telling us, that the market is willing to pay today to get these barrels delivered to market, and there's no incentive at all to store product. Thus, you don't see a lot of building in inventories when you see a market structure like this. Why would somebody want to put their diesel into inventory, knowing that the outer months are worth so much less than what it's worth in today's market? So this is a bullish setup. We want to continue to watch this for any indication of the market turning here, but for right now, I think this is really an important story. Looking at the supply-demand situation, we continue to run at the lower end of the 5-year average. Some pretty low inventory levels as reported by the EIA. Turning those low inventory levels into number of days supply, this is an overall snapshot of that inventory divided by the current demand, and it's currently showing that our number of days supply is at some really low levels. For this time of year, it's the lowest that we've seen in a number of years. So again, this just continues with the bullish story on the supply and demand situation for our heating oil going forward. This can turn in a hurry, but we're really going to need to see a break in demand in order to get this to turn around and start building some inventory levels here. And if we do get that break in demand, I think we'll also see that forward curve start to flatten out. But in the near-term horizon here, we just don't see that happening as we continue with the fall ag demand being extended pretty late in the season and moving right into the heating season today. With those scenarios set up, I do have a hedge strategy that I like, and as you can likely tell, I'm pretty bullish on the market as a whole here, and I think we need to be active out into next spring, start putting our contracts into place here. And I guess the options that we have is to look at just buying the straight out fixed price contracts, get them in place, or we can look at some option strategies. If you're not comfortable taking the risk on the fixed price contracts, we can put some option strategies together to allow for some downside cushion, give you some price protection on that. Or the third piece that we can do is use this hedge strategy to give you some protection also with this current market structure that's in place. And I feel if we keep this backwardated forward curve in place like we've seen, this whole market's going to continue to rise because we will not build inventories at all. And in that case, we'll gain on the fixed price contract or gain on the option strategies. If we do see some weakening in demand, and the market starts to drop, I think we'll see that on the front end first before we see the back end drop. And so we can put a hedge in place where we're going to sell the January futures contract and at the same time buy the June futures contract at the spread that's currently running 4 to 5 cents. And the idea behind this, if we do get some softening, the front end's going to come down faster than the outer months, so we'll gain on this hedge strategy where we can protect a little bit of those outer months that we do have in place. If you'd like to hear more on this strategy or talk through it, feel free to give us a call. We'd love to discuss the strategy with you and kind of give you our opinion on the market. And as mentioned, you can tell we are pretty bullish this market right now, and we really need something to see something to change on the demand end to not have this bullish feeling. So give us a call. We'd love to visit with you. Thanks for listening.